We are looking at a summer where large amounts of money, trillions, will change hands, says Credit Suisse analyst Pozar, who has warned investors that the bear market has 50% more to go before a bottom is found. This analyst, who has accurately predicted obscure movements in the market, explains the markets have compressed due to being grossly overvalued, but still have 50% to go. This is due to expected decreases in earnings from economic headwinds. This analyst is expecting the market crash is only half over because companies are expected to announce and forecast lower earnings in upcoming quarters. So before we jump to conclusions and stop investing, how can we best weather this storm to generate passive income and hedge against the recession while the bear market gets worse? A strong dividend portfolio can increasingly pay you monthly without fears of market crashes. Owning great dividend companies or ETFs can ensure your portfolio can weather the storm and give you the cash flow you need to retire early. Investing in a combination of high yield and dividend growth companies can supercharge your passive income as you patiently wait for your favorite dividend growth stocks to fall to reasonable prices. As you generate more cash flow from consistent high yield dividend stocks, once safer dividend growth stocks have come down in stock price, you have a huge amount of cash to reinvest into these great bargains. Buying the dip on Dividend Aristocrats can create great opportunities for investors with long-term time horizons. Hey Raylaners, you look so confident today. You look like $1,000,000. In today's video, we will discuss 2 Dividend Aristocrats I'm buying with a 7% yield. Top metrics I look for to invest in recession-proof dividend stocks. The top consumer dividend stock that crushes recession fears, and a portfolio update of what I bought and sold this week. At the end of this video, we will also discuss how I stay positive in this bear market because a few of you had questions about that. This is a fun, educational, interactive investing video, so if you would like to invest with me to retire early, click the link in the description below to get my free dividend tracker that I use to track this portfolio. I usually update this spreadsheet once a month, and it takes me about 5 to 10 minutes. Let's all create financial freedom for our families and generational wealth that no one taught us how to do when we were younger. 2 dividend stocks I bought last week with over 7% dividend yield are Altria and EPD. After raising dividends for the past 24 years and spending hours researching their financials, I wanted exposure in these recession-proof stocks. To see a more in-depth analysis and reasons why I bought ticker symbol MO and EPD last week, click the link in the description below for last week's portfolio update. I will add to these dividend growth stocks in the coming months. To add these stocks to the tracker, go to the template, click Insert, click Rows, and click Insert one row below. Highlight the row below shares all the way to annual income and click Copy or Command-C on my Mac. Highlight Altria's row from shares to annual income and click Paste or Command-V on my Mac. I have 1 share of Altria with an average share price of $42.05. The current price is $41.52, so the total gain generated for me is negative 0.53 cents. The annual dividend, which is at nasdaq.com in case anybody was wondering, is $3.60, and the dividend yield for Altria is currently 7.5%, so you can add that to your dividend tracker. My total dividends are generated for me. For my 1 share of Altria, I will make $3.60 in annual passive income. Let's insert a row below for EPD. Add Enterprise Product Partners, symbol EPD, and copy the row below shares to annual income. Paste for EPD, then type in the number of shares you own, your average share price, and the market price. The annual dividend is $1.90, and the yield is currently 7.88%. If you would like to see how to work this whole template or create your own dividend tracker using an Excel spreadsheet, click the link in the description below. As a disclaimer, this portfolio is only 10% of my overall portfolio. I know a lot of you have been asking why. I mostly invest in VU, SPY, VYM, and SCHD. So that is most of my portfolio overall, and it's what I suggest for beginner investors to invest in as well. This is a high yield combined with dividend growth portfolio. I started investing more aggressive in high yield as stock prices were too high for me personally, so now the portfolio is mostly high yield. Now that there are extremely undervalued dividend growth stocks in the market, I will slowly begin adding back into my favorite dividend growth stocks until this portfolio is balanced to 50% high yield, consistent stocks, and 50% ride or die dividend growth stocks. My goal is to get to $1,000 a month in dividends alone with this portfolio. To find resilient and consistent dividend stocks that are recession-proof, I look for a few key metrics. With increasing revenue and dividends, companies reward shareholders each quarter or month with passive income. Through investing and DRIP, or reinvesting dividends, investors can create a snowball effect that will make your money work harder for you. First, I look for 10 years of profitability. I want to see revenues increasing year over year, continually. I want to see free cash flow and net income increase as well, even in times of uncertainty and market turmoil. I look for a sustainable dividend that has increased over the past 10 years. I am looking for a company that rewards its shareholders with cash flow and have not cut dividends. Altria is a great example of a company that has provided dividends for many years with consistent raises. While the stock price fell from 2017 to 2020, the company continued to show resilience with sustainable cash flow and increased dividends. It is now at an attractive price to buy according to my DCF and analysis. Third, I want to see a sustainable payout ratio. This metric shows the proportion of earnings a company pays its shareholders with dividends, expressed as a percentage of a company's total earnings. This shows investors if a company has enough earnings to pay investor dividends for a long time. 0 to about 35% is considered a good payout ratio. If a payout ratio exceeds earnings, this may be considered a yield trap, because the company will need to use debt to pay dividends. Unfortunately, this isn't sustainable and often leads to dividend cuts. If you invest in REITs or real estate investment trusts, these companies under law are obligated to pay investors 90% of their earnings. Thus, the payout ratio will be much higher, but may still be sustainable. Fourth, I look for companies that are undervalued in an upward trajectory. Looking at the maximum stock price, we can see EPD stock price has steadily increased throughout the years. We check the historical average price per earnings ratio, or PE ratio, and we can see a nice average steady PE ratio of 12. Fifth, I look at the company debt. If a company has a lot of debt, management may find it difficult to run their business during hard economic times. I look for debt to EBITDA being less than 3. The lower the ratio, the higher the probability of the company successfully paying off its debt. With these metrics in mind, dividend investors can confidently select companies that will pay them on a regular basis to retire faster. One company specifically impressed me. The top consumer dividend stock that has shown impeccable resilience is Costco, ticker symbol COST. While competitors have been decreasing margins with selling backed up inventory at high discounts, Costco recently announced sales rose by 13%. Costco is a merchandise club retailer in the consumer discretionary space that has endured 4 major recessions since its IPO in 1985. One of my favorite reasons to buy Costco is its sustainable business model. Costco uses sticky annual membership plans to generate most of its profits. Thus, it doesn't rely on cyclical consumer spending and creates long-lasting customers. It is not dependent on low-margin retail sales and has steady growth due to this type of business. While they have a steady business model, this stalwart has been growing and expanding as well. Membership rates hit all-time highs of 92% and 90% globally. Costco easily has enough pricing power to increase membership fees to hedge against inflation. It is also opening new stores while other retailers are shutting down. Last quarter, Costco had 830 stores compared to 809 year over year, and it is expanding into Europe, Asia, and Australia. Costco is currently $502.75 with a market cap of $222.62 billion. It has a 52-week range of $404.53 to $612.27 with a PE ratio of 39. From 2018 to 2021, revenue has steadily increased from $141 billion to $190 billion. Earnings have also increased from $3.13 billion to $5.01 billion. While Costco has a low dividend of 0.72%, dividends have been consistent and increasing since 2004. Costco is also known for surprising shareholders with specialty dividends every few years, but no one knows when that happens. For example, in 2020, the company paid a $10 special dividend to shareholders. That's right, if you held one share, you would get $10. In 2004, Costco paid 10 cents in dividends, then increased to 13 cents in 2006, 16 cents in 2008, 20 cents in 2010, 35 cents in 2015, 65 cents in 2019, and it is currently at 90 cents. It has a dividend growth rate of 12.76% for the past 10 years. This means dividends have increased 12.76% each year, or more than doubled every 7 years. I also see a few future opportunities. With rise of inflation and recession, more customers are buying in bulk, which is Costco's specialty. This year alone, sales rose 13%, store traffic was up 10% year over year, and core US sales improved 13%. Costco is even growing in the e-commerce space with 13% increase in sales. Jefferies analyst recently stated Costco will deliver sales 1 to 2% above historical levels this year based on shifts from traditional grocery stores, higher growth among Gen Y and Gen Z with stronger club offerings, and bigger baskets as customers increasingly shop categories beyond food. Last, we can see slow, consistent growth in operating margins. While consumers are more likely to buy in bulk to cut inflation costs, this helps Costco maintain margins. Analysts expect revenue to increase 15% this year and 8% next year. With this impressive track record, I'm personally adding Costco to my watch list. Now, this is not financial advice. I am simply doing this for entertainment purposes only. I'm just an NYU finance student. With a high PE ratio, Costco may seem overvalued at the moment. Competitors are trading at a much more attractive price, but for good reason. I personally believe Costco is doing extremely well under pressure and deserves that premium. Because after this market crash, I believe they will have an even brighter future. Having said that, Costco's historical average PE looks a bit rich, and I would like to buy more if the price drops. I believe we still have plenty of headwinds, and I would like to buy Costco under a 30 PE. If you are not concerned about the stock price, I believe this is a great dividend company to own. Just note we may see a big price drop, so I will patiently wait for the price to become more attractive under a 30 PE, ideally 20 to 25 PE, as long as management continues its impressive track record. Let's go back to our template and insert a row below. We will add Costco with symbol COST. We will put it in yellow, which means it's on our watch list. And to the far right, let's add buy under 30 PE, at least if nothing changed. Then note that I would ideally like to see 20 to 25. While continuing to watch potential stocks to buy, I bought and sold a few things in my portfolio. My portfolio is currently $48,436.40. So close to $50,000. And I wanted to give a shout out to my mentor, Darth Dividend on YouTube. Give him a follow on YouTube because he has given me a lot of advice about dividend investing and has a great channel. Currently, I am down 17%, but I am beating the S&P 500 with a yield-to-date return of negative 19%. Earned dividends are $2,852.94. This week, I added $100 to the portfolio, and I bought $25 worth of MO, $25 worth of EPD, $19 worth of sach, and $31 into divo. Since I only track full shares, we do not need to update Altria. Let's add 1 share of EPD. This dividend stock is giving investors dividends soon with an ex-dividend date of July 28th. Investors who want dividends of a company must buy shares before the ex-dividend date. So to receive any upcoming dividends, I want to buy more EPD as I'm able. EPD has a current price of $24.97 with my average price at $25.03. The dividend is $1.90 with a 7.61% dividend yield. Let's add a row for Sachem, or ticker symbol SACH, which is one of my riskier high-yield dividend plays, but they announced a dividend raise of 17% from 12 cents to 14 cents for their next dividend payout. While the stock price has been volatile, the company is well positioned to grow by 34% according to analysts. With a well-diversified portfolio and low default rating of first lien mortgage loans, this MREIT has increased revenue and net income this year, which is very impressive to me considering high interest rates. I believe sach, while yielding a high dividend, is a nimble company that can be flexible as needed with their short-term loan business model. I will add 9 shares with my average share price. Sach is currently $4.59 with a dividend of 56 cents and a dividend yield of 10.74%. Investors who own this stock before July 21st will receive the dividend. Let's add 1 share of Divo. This is the Enhanced Dividend Income ETF and ticker symbol DIVO, and is currently at $34.02. I will add 1 share with a dividend of $1.70 and yield of 5.23%. This monthly dividend ETF is a great hedge against capital depreciation because since its launch in 2016, the company has been devoted to offering high levels of return with little risk, featuring high-quality blue-chip companies with a long track record of dividends. It has an annualized total return of 13.9% and is down only 4% yield to date compared to the S&P 500's negative 19%. I also sold 1 share of IEP because it is at a common resistance level and I would like to buy stocks I feel are more undervalued. You can see my full portfolio update in the link in the description below for June, where I had my biggest dividend month so far. You can see total dividends are at $4,864.21 with these buys. While this bear market may seem like there's no end in sight and our portfolios are bleeding, there are a few things I personally do to stay positive in a bear market. I had a few people in the last video ask me how I was not afraid of a big market crash, and I just wanted to give you a few tips I use. First, I changed my mindset from fear to opportunity. This market has given us a lifetime opportunity to create true wealth. I love to go to the mall, so I think about bear markets like buying my favorite Michael Kors purse at 80% off and then being able to resell it at a later date for its full value. This is a great opportunity for patient, long-term investors who want to grow. Second, out of sight, out of mind. I automate my investments and stop looking at my portfolio daily. I will only update it once I do this video, then let the markets panic while I go to the gym. Constantly looking at the markets and seeing red leaves me stressed out and impatient. Third, I think quality over share price. I give myself a goal of buying 100 shares of a great company I believe is undervalued. This way I can sell cover calls and make even more income. So if you're struggling a bit or losing confidence in these markets, just pause, reset, and try these simple steps. So now that you know which stocks I'm personally buying and are on my watch list, let me know in the comments below what stocks you're buying, which ones you're selling, or what you're doing with your cash. Are you investing it or are you staying on the sidelines and waiting for the bottom of the market to come in? Let me know in the comments below, and as always, please like and subscribe to get investor tips and so the algorithm can send this to as many investors as possible. This is Supergirl Investor here to save the world and make you wealthy. I hope you learned something today or got a tip or just got this free dividend tracker link in the description below so you can track your dividends. I love each and every one of you and I wish you the best success in the world. Have a safe and happy and healthy week. Bye everyone.